The market is open and we see some very mixed results right across the board. We also noticed that this week earnings season truly kicked off with some very large names reporting, especially in the semiconductor industry. We had ASML as well as Taiwan Semiconductors giving us a little bit of a preview of what to expect for this industry as a whole. Next week we also see some large corporations reporting, and following this week on Monday we do have Alphabet reporting. Now this is a company that is up 19% over the last 12 months. It has lagged the S&P 500 up to this point. Over the last 52 weeks, well, it is trading in the midpoint of that range. We also notice a strong buy rating from Quant, a buy from Wall Street, and a buy from Seeking Alpha. As we said, they are reporting very soon, so should we consider buying this for some massive gains moving forwards? We're going to run through and give you our thoughts in today's episode, and we're going to start off with how they performed in their latest quarter. As we can see, they had better than expected results, and a lot of this was driven through that cloud revenue. To those that want to see the actual numbers, well, the EPS 144 versus the 134 anticipated by the market. Revenue also looking very good, 74.6 versus 72.82. We can also see that they did beat on these metrics. The market for Alphabet do like to look at some other metrics in detail. As we said, YouTube ads looking good. Cloud revenue also a beat, as well as the traffic acquisition costs. So overall, this did look like a very strong performance in their previous quarter, but there are some other things that we do want to consider in this company moving forwards, not just about their cloud revenue or about YouTube. That this is a company that over the longer term has done some acquisitions in some very large companies. Some, as we can see, have been very profitable. Some maybe you haven't heard of, and therefore pretty much tells you all you need to know. In terms of looking at this though, we want to really highlight Waymo, which is something that does go under the radar when you do think about this company. They have continued to invest a lot of money into this essentially self-driving car unit, and as we can see, around July this year, they invested an additional $5 billion. Now about this company, they are doing a lot of very interesting things which you could argue overlap with Tesla. Whether or not you believe both can coexist or whether Tesla will knock this company out, that is something that we can consider, but we also noticed from just earlier this month, they have begun to test their fully autonomous vehicles in San Francisco, which will be very interesting to see how successful this becomes. As we saw, there have been some very strong acquisitions for YouTube. Whilst this may not be an acquisition as per se, it is definitely something we want to keep a very close eye on. We also have to discuss the DOJ that has probed this company, not something that you want to see as a shareholder, but effectively what the DOJ are saying is that they believe this company is an unlawful monopolistic in the online search, and a few ways that they can consider to get over the issues they have. They've considered at length at breaking up this company and having it into different parts, which perhaps you could invest in. A lot of people do consider this a bullish scenario, others consider this bearish, something just to think about. Although what we do want to flag when we take a look at this detail, especially if Alphabet do effectively appeal, something that we do think will happen, this could essentially extend that timeline to around 2027 or 2028. Therefore, whilst we may get some volatility from the share price over the next few months, over the next few years, this isn't something that we would consider in our overall investment thesis, but the information is there if you do believe this is something that will come. So just to conclude on this specific point, whilst there is a hearing in April next year with a conclusion expected in August 2025, if it isn't something that Alphabet themselves do like to hear, they could appeal and this could further drag on over the next few years. If this concludes anything like the Microsoft case, then this probably isn't something you're going to have to worry about as an investor. As we can in fact see, Microsoft did settle pretty much a year after the judge said that there should be a breakup. Now let's get back to this company, just a very quick level. Over the last 10 years, they have outperformed significantly the S&P, up 496%. They do currently offer a forward yield of 0.49% with a forward P around 21.29, which is lower than the S&P right now, trading around 24 to 25. Now, in terms of looking at their earnings and the expectations moving forwards, looking at the next 4 quarters of their earnings, they're anticipating 3 of them to be double-digit increases, notably the next quarter, as we said, reporting in 10 days, 19% growth year on year, and always good to see over the last 4 quarters, they have outperformed analyst targets by quite some distance, so 100% track record, probably giving you faith their 2025 estimate they can hit, which in turn will lower that forward PE down to 18.73. Now a quick highlight of some of their key metrics. Dividend safety score 80, so that is good to see. We'll discuss dividend yield theory, but when we look at the valuation in terms of the forward PE, we do get a very strong signal here of undervaluation. Now, what does a score of 80 mean? Well, firstly, it was reaffirmed in August, and it ultimately means a dividend cut, even though it is very new for this company, is unlikely. Now, in terms of the key metrics from the last recession, we don't have any comparative dividend data. They weren't paying a dividend during the 07-09 crash. We do in fact note they had plus 8% sales, which was well above the average of the S&P, sitting at negative 12. As we can see then, based on the forward PE over the last year in more recent terms, this company has been trading at the lower end of the intrinsic value that we can note from the blue tunnel. But what we note over the last few months, it has been trading in fact below the lower end, which is a massive sign of undervaluation. One we will come to a conclusion when we run it through our own valuation model. Now, whilst we look at dividend yield theory on this channel that states a company is undervalued when the current yield sits above the 5-year average, as they are a new dividend payer, we won't analyze this today. But what we do want to flag, based on the forward PE, which sits around 20.3, that is lower than the 5-year rolling of 23, so another undervaluation signal. We can see here though that the communication sector as a whole does sit lower at 18.3, but as always you could argue, and probably rightly so, that Alphabet does deserve to be trading at a premium. How much of a premium? Something we will consider today. In terms of the free cash flow payout, and as always, free cash flow data over earnings, which is susceptible to manipulation by management through accounting, below 60% is what we want, 12% over the next 12 months, 4% on a trailing 12-month basis. So we do anticipate moving forwards, Alphabet will be increasing these dividends at a very favorable rate, ideally at the double digit, something we love to see as dividend growth investors. Then we move on to the free cash flow per share, where we want to see consistent increases over the long term. Something nice to note from this company, in fact, more than 5 times over the last 10 years, and expected some significant growth over the next 12 months to $6.71 per share. Then we get to the sales growth, where we see double-digit increases to the top line every single year, bar 2023, even though we get the 13% on a trailing 12-month basis. And as we want to see a minimum of 3 to 7%, it is nice to see that Alphabet has been doing very, very strongly, continuing to perform very well, which ultimately, when we do look at their top line growth, has been very strong, nearly 5 times, 66 billion in 2014 to 307 in 2023. Over the longer term, they've also done share buybacks, essentially giving you excess cash as an investor, although we do note from 2014 to 2018, they were doing the opposite. They were issuing shares, diluting your position. From 2018 though, as we can clearly see, year on year, whilst inconsistent, they are doing buybacks. Then we move on to one of our favorite metrics, ROIC. 10% or more, give us faith, management are able to effectively allocate their capital, and we notice above that every single year. Last 3 years looking very, very strong, 31% on a trailing 12-month basis, as we can see, making it very attractive to investors and potential investors. Operating margin, not just above 12% year on year, but we also get a little bit of operating efficiency, 26% in 2014, 29% in 2023, and as we do want to see with high quality companies, increase your top line revenue whilst increasing your margins. Free cash flow also looking very strong, above the 5% minimum year on year, so you could argue it is a free cash flow machine. Net debt to EBITDA, the best that we can get on this channel for this metric. EBITDA referring to earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see. Below 3 is what we get. In fact, 0 every year. And these are the number of years it would take the company to pay off all of their debt net of cash on hand. It won't even take Alphabet 1 day to pay it off over the last 10 years and over the next 12 months expected. So a very, very strong balance sheet, and no surprises why the dividend is safe, as this correlates to both balance sheet strength and dividend safety. We also want to let you know we have released our latest free weekly article. We deliver one to your inbox every single Monday morning, where we talk about what's happened in the market, as well as running through undervalued stocks that we do believe deserve your attention. So click on the pinned comment below where you can sign up and read straight away. You'll also be able to gain access to 36 undervalued stocks for the month of October. We talk about these in detail as well as the upside that Wall Street see over the next 12 months and flag those that sit within our own portfolio. And for this month as well of October, you can in fact grab a 22 undervalued dividend spreadsheet where Wall Street have run through those stocks that they believe have the most upside in the whole S&P 500. Now, when looking at insider ownership, we see this sit around just under 12%. We notice 120 million worth of sales over the last year. And in fact, in the more recent quarter, we see 8.45 million worth of sales. When we take a look at see who these insiders are, we can in fact see the CEO himself just 2 days ago sold around 22,500 shares at $166, netting him just under $4 million. Yes, this is fairly recent. In fact, we do get quite a lot of insider selling by the director as well as the chief accounting officer just over the last few days. But we do want to point out this isn't necessarily a bearish signal. Management sell for many reasons, personal or financial, but as always, transparency is there if you want to use it in your own investment thesis. We then look at institutions, around 40% ownership, 33 billion worth of sales over the last year. Same time period, we see a lot more buying, 53 billion. And in fact, we notice in the more recent quarter of 2024, we can see a lot more buying than selling, and the same to be said in quarter 2. Now remember, whether institutions buy or sell, always do your own due diligence, but we do notice the trend. They have been buying more over the last 12 months as well as the more recent quarters. Now, in terms of their top line, we've already looked at this for Alphabet, but we just want to show you that strong growth over the last 10 years. As we said, around 5 times from 66 billion to 307. But realistically, this part comes down to the bottom line. We want to show you, does that trend follow suit at the net income level? And the answer is yes. A little bit of inconsistency, as we can see over the last few years. Nonetheless, it has gone from 14 billion in 2014 to 74 billion in 2023. So growth is very strong, both top line and bottom line, and is expected to continue, as we can see on the trailing 12-month basis. Now, in terms of the health check, we already showed you net debt to EBITDA at 0, not even 1 day to pay off all of their debt net of cash on hand. As we can see, cash balance, whilst inconsistent, has been growing over the last 10 years, following suit with their other metrics, revenue, bottom line, going from 63 billion in 2014 to 101 billion in the latest quarter. Now, you can't look at any one metric in isolation, which is why we compare it to their total debt numerically and directionally. And what we can see, like other metrics, their debt has also been increasing from around 8 billion 10 years ago to 29 billion in the latest quarter. Nonetheless, their cash position is more than 3 times as large, so no surprises, they can pay off all of that debt very quickly. Very good balance sheet. Now, in terms of some of their gradings, they do get a D on valuation. When you understand, there's no surprises, given the fact that in terms of a forward P, it does trade significantly higher than the sector. In fact, if you're buying Alphabet today, you're paying just under a 60% premium. But as we said, we do believe it does deserve that premium, and you can pretty much see whichever valuation metric you use, Alphabet right now is trading above the sector. Is it worth it? Well, that's something we need to come to conclusion, and we notice their growth does look better than the sector with a B-, 13% year on year with the sector at 2%. Moving forwards, still double digit at 11%, sector at 2.84. And when we look in terms of earnings per share over the next 5 years, growth of 17% year on year is much better than the sector median of 10.2. When we look at the profitability, again, looking better than the sector, 58% on the gross profit margin, 52% from the sector median, 27% in terms of bottom line net income, 3% from the sector median, and something we do love, and in fact want to highlight, not only very strong in terms of cash from operations at 105 billion versus the sector of 282 million, but it has in fact in the Magnificent Seven one of the largest cash from operations, not something to look at lightly. So quick conclusion for this part of the analysis, a double buy from Seeking Alpha and Wall Street, a strong buy from Quant, D on valuation, B- on growth with an A+ on profitability. Now, a few things before we get straight into the valuation, comparing their performances against others in the industry. Now, what we do notice in terms of total return, so including dividends reinvested, They are in the middle of their competitors, as we can see 19% growth over the last 12 months, but we also know some have performed very poorly and some, like Meta, have performed a lot better. Over the last 5 years, we can see Alphabet one of the best, again up there with Meta. Over the last 10 years, looking very, very strong, up 500%. You wouldn't complain if you got this return over the next 10 years. Question is, do you believe that can happen, as past performance is no indicator to the future? We also want to show you its performance against the S&P. Over the last 12 months, as we mentioned at the beginning of the episode, it has underperformed. When we look over the last 5 years, we can see it has outperformed, as well as over the last 10. So do you believe it will continue? Do you have that faith? Or is investing in a low-cost ETF the better solution? Again, questions you need to ask yourself. Now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $188 came from the DCF model, and as we can see, we have the free cash flow year on year, average growth rate 24%. Moving forwards, we've actually gone very conservative today at 10%, lower than the average of the last 10, lower than the more recent increase, but we have 3 different growth rates here, low, medium and high. Now when we do the 10% with the discount rate at 8%, we have the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can see here, an undervaluation signal indicating upside of 15%. As always, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Alphabet or any other company. For full transparency, we'll show you the other rates. At 15%, an intrinsic value of $265, giving it 63% upside, and at 20%, which some people may say is actually still very conservative, intrinsic value $372, upside of 128%, indicating that in fact there is more than double the current trading price. As always though, we are going to take through our rate of 10%. We're going to take it to the next slide, where ultimately we are going to use a margin of safety. Now on this channel, we always start off with 10%. We execute on that if it hits our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now if you believe that, in today's episode, a buy up to $169, then we keep going till it's near the current trading price. Not at 160 yet, which would indicate 15% MOS. So in today's episode, sitting somewhere between 10 to 15%. For those that want to see more, well, at 20% MOS, a buy at 150, at 25% at 141. And in today's episode, if you want that 30% margin of safety, you would need to wait for $132. As we said though, sitting somewhere between 10 to 15% MOS in today's episode. Wall Street themselves giving this 24% upside. As we saw, triple buy rating, in fact Quant giving this a strong buy, Wall Street giving this a $202 price target over the next year, giving that 24% upside. As always, give us your thoughts in the comments below. Is 10 to 15% MOS enough for this company? Are you looking for more? Maybe you're looking to buy before earnings. For me, this is a very strong company. We have gone, in fact, with a very low rate at 10%. So this does look to be a very good buy around the 10 to 15%. One you could consider to dollar cost average in, or if this isn't one that you are sufficient in terms of the MOS, you could wait to see if it does drop before the earnings, but it isn't guaranteed, and we have seen Alphabet does typically have a 100% track record over the shorter term in terms of outperforming analyst targets. As always, give us your thoughts in the comments below. Are you looking to buy, maybe hold, or in fact sell? And if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter where we are dropping a new copy on Monday morning, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.